Hello, my name is Jingonelli, and today we are going to be looking at another tutorial. But before I begin off, make sure you subscribe to the channel. It will bring you some good luck in your forthcoming exams.
So majorly this is what we do in a financial audit. We do test controls, whether they are working. We verify the figures and disclosures in the financial statements to confirm that they are true, to confirm that they're in line with the applicable financial reporting framework. That is the IFRSs. You know, in Uganda, ICP, we adopted the use of IFRSs in the preparation of financial statements. So we are checking whether they followed IS1, whether they followed IS2, whether they followed IS16 for assets, PPE, whether they followed IS2 for inventory, whether they followed IFRS 13 for fair values, and many others. So that's why we are verifying the figures and disclosures in the financial statements. But before that, we first test the controls, the policies in the entity, the policies being followed or not. There are many policies. You looked at them in topic 4. So this was topic 4, which I will not repeat. And this is topic 5, where we are auditing the financial statements. Now, we audit financial statements using substantive audit procedures. We use the substantive audit procedures or audit tests. And when we talk about substantive audit procedures, and that is what is bringing us topic 5, we're going to study these audit tests or audit procedures, the ones we use to audit the financial statements. But in a combined audit approach, we use both the tests of controls and the substantive tests. You've already looked at the tests of controls in topic 4. Substantive procedures, we mean the audit procedures used to detect material misstatements in the financial statements. You all know financial statements at this time. You know the statement of profit or loss and other comprehensive income. You know the statement of financial position. You know the statement of cash flows. You know the statement of changes in equity and the explanatory notes in the financial statements. So we audit them using substantive procedures or substantive tests, or what we call substantive audit tests. So they are the tests we use to detect material misstatements in the financial statements. There are 3 types of substantive procedures, and one of them is the analytical procedures. Analytical procedures is the first substantive procedure. And for analytical procedures, we are looking at comparisons. We are comparing financial data and non-financial data to ensure that, to find out whether there are any significant variations. So this can be an example of an analytical procedure. Used audit payroll. Assuming you're auditing payroll expenses, you're going to use one of the tests you're going to use, one of the substantive tests is the substantive audit analytical procedures. So how do you do it? You compare. I've told you it's a comparison. You're comparing information. You're comparing information to find out whether there is any significant variations or not. So, assuming you're auditing your payroll, you put the months, for example, January, February, March, April, May, June. We're now in July. So we don't need these 2. Now, you look at the net salaries, you may find that here it's 90 million. Here it's 90 million still. But from nowhere it jumps 120 million. Then it again comes back to 90 million. A minute. We continue. I had told you I had paused. So some of you, I think you don't follow what the lecturer be saying. I told you I was pausing, but somebody is asking where I am. I'm saying if you are using analytical procedures, for example, you have to audit payroll expenses, you find January you have 90 million, February you have 90, March you have 120, and April you have 90. Then May we have 70 million. You find here it's 90 million again, and then here it's 90 million. So using analytical procedures, you're going to compare. It's a comparison. You're comparing information. You're going to compare. This is how you write the test. Compare the payroll expenses e.g. net salaries for the months, for all the months. Establish any significant changes. Now you tell us the assertion you are testing. In topic 3, they taught you assertions. Which assertion you are testing here? In order to verify completeness, accuracy, basically completeness and accuracy of payroll expenses. So, for example, normally payroll doesn't just change because most organizations don't just recruit people. They go by the plan. Now, you see, we start with 90 million. Now I'm comparing. You, the auditor, you draw this one by yourself. 90 million in January, February it's 90, but from nowhere, March it goes to 120. So why this increment? Why this big increment from 90 to 120? What made it increase from 90 to 120? You find that this shows that there's a risk here. This shows that there is a risk because payroll expenses can't just increase from 90 to 120. So analytical procedures helps to show you where the problems could be. Like this one here, it's showing us that here, there is a problem here. Also, it is showing you that there is a problem around here from 90 to 70. So these 2 months, May and March, have issues. So analytical procedure just compare. When you compare, you get to see the significant fluctuations, the significant increases and decreases, which could be points of concern. And they're showing you where the risk could be. You get it. You can also compare the actual and the budgeted figures. We're going to look at more of this. Other analytical procedures you can do are here. You can also compare, apart from comparing like monthly, you can also compare techniques for analytical procedures. You can also compare the entity's financial information with comparable information for prior periods. So you're comparing current period and the prior period. The year is 2022. Then you have 2021. So did the expense increase or it decreased? E.g., you're going to find electricity expenses. If we are doing electricity, we're auditing electricity expenses. In 2021, they are equal to 140 million. Then versus 2022, where they are 100 and 200 million. So when you compare these two, you're going to see that there is a big increment from 140 to 200. That's the point of concern. If it's, I'm not saying that it will remain the same. It cannot remain the same, but why that big increment? What is causing that big increment? Is it because they are stealing some of this money? You get it. So our concern is the big increments or the big declines. You get it. Those significant increases or significant decreases. So you compare the current year information with the previous financial year information to establish whether there are significant increases. Some accounts, it is bad for significant increases, like expenses. You don't want expenses to over increase. But other accounts, like revenue accounts, for them, we don't want decreases. So for revenue accounts, we shall look whether there was any significant decrease. Also, you can compare the entity's financial information, the current information, the current year financial information with the budgets. So this is actual and budget. If we budgeted to spend 80 million on salaries, how much have we actually spent at the end of the year? If we spend more, there is a problem. That means we're not following our budget. In cost accounting, they taught you budgeting. We're supposed to follow our budget while we are spending money. We're not supposed to overspend our budget. If you budgeted for 100 million, you can exceed it, yes, but slightly. They normally increase only, they normally accept only 10% increase, most organizations. But if you find you budgeted for 100 million and you're spending 300 million, then there's a problem. You budgeted for 100 and you're spending 150, then there's a problem. So analytical procedures, we compare the actual and the budgeted. And if there are any significant increases or decreases for specific accounts, then there's a problem. It is an indicator that there's a risk there. Also, we compare the entity's information with the expectations prepared by the auditor. You, the auditor, you always have what you think. For example, you may think, your thinking is a building is going to be depreciated, like, for example, by 2% or by 1%. But you find when they have depreciated it by 10%, then there's a problem. So you, the auditor, you have your own, because you're an accountant, you're a professional accountant, you have your own best practices, you know. So if you find that they have deviated from them, then there's a problem. You can also compare with industry information. You compare the entity's information with the industrial information. Industrial averages in financial analysis, you call them industrial averages. What is the best practice in the industry? How are other companies performing? For example, you have MTN. If you're auditing MTN or you're auditing Airtel, you're going to look at the revenues of Airtel and compare them with the revenues of MTN. If there's a very big difference, then there's a problem. You're going to compare the revenues of Crown Beverages with those of Central Bottling Company. If there are big differences of different accounts, then you're not matching with the industry and there is a problem. So those are some of the comparisons you do. You can also compare the rated items. For example, you go to the assets schedule. You remember the PPE schedule from IS 16. So you go to the PPE schedule, you compare rated items there. For example, you can compare the depreciation of one asset with the other asset. Depreciation of buildings with depreciation, let's say, of furniture. Those have different rates. They have different useful lives. So is there that difference or it's not there? If you find that they are being depreciated the same way, then there's a problem. We're going to look at the repairs and maintenance expenses, for example, for the current year and the previous year. How much did they spend on repairs previous year, current year? If it is just increasing, then there's a problem. and many others. So you can also compare financial information and non-financial information. For example, if you're using IS 41 agriculture, you're going to compare on the farm, there's 100 cows. Then you look at their value. The number of cows, that's non-financial information, like 100 cows. That's non-financial. Then financial is the value of those cows. If you find that there are 100 cows on the farm, which is non-financial, you compare with the figure they have attached to them. You find there are 2 cows on the farm, but there are 2 billion, meaning each cow is 1 billion. How can that be possible? So you compare non-financial information with financial information. For example, there are 2 cows on the farm. If you find 2 billion in the financials, then there is a problem. How can a cow be 1 billion? You look at, they have 10 pieces of furniture, but they tell you those 10 are at 100 million, meaning each is 10 million. So you go and confirm, is it actually 10 or not? So you look at the payroll costs. You find you have 10 workers, that's non-financial, but you find those 10 workers are being paid like 1 billion, meaning each is getting like 100 million, then there's a problem. Yeah. So is the non-financial information matching with the financial? And then you also do reasonableness tests. Reasonableness tests, here we look at, we use our judgment as auditors and look at the expected values of the items and compare with the actual. Expected with the actual. I've already explained, given examples here. So those are some of all these are examples of analytical tests. So for example, reasonableness tests, you can look at here I've given the example of straight line method of depreciation. It is supposed to be cost minus disposals times the rate of depreciation, you get it. So you go in the statement of profit or loss and find out, have they really done it like that? Or they have done something different? There are other analytical procedures you can do, like changes in products, customers, and levels of returns. So you can compare products in the current year with those in the previous year. Have they added another product or not? Customers, how many customers did you have last year? Are you increasing them or you are decreasing them? So such kind of comparisons help so much in auditing, and they help you to come up to show you where the problem could be in the financials of the client. Okay, you can also compare the effect of price and product mix changes on the cost of sales. We always have the effect of the prices and the costs. So how much, when you compare the price you're selling the product vis-a-vis the cost you're spending on it, is the cost increasing or reducing? If the cost is increasing, then there's a problem. Then you can also compare inflation in the current year with the previous year. For example, right now the inflation rate for the country is skyrocketing. What's the current inflation rate? Right now the inflation is around 5.5%. So you find that it has increased from around 2.16 in like March. So from 2.61 to around 5.5 now. That's a very big increase. So you compare inflation in 1 month with another month, or in the current year with the previous year, and confirm whether there are any significant increases. But also we can look at.
So excuse me, you said how many is the rate for inflation rate, the current inflation rate?
You must keep listening. In June, it was around, I said in June, it was around 5.5. And right now in July, the headline inflation is almost 7.4.
Okay, thank you.
Use the inflation figures in the auditing.
Yes?
How do we use the inflation in auditing? Like, how does it apply?
As an auditor, you're auditing a company, you're helping it to increase its performance. So you're trying to find out, you're auditing these figures to see how is inflation affecting the company. If inflation is increasing, that means it's affecting the financials of the company. It's affecting the sales, it's affecting the purchases. They're spending more money on purchases. They're getting less from sales. We are dealing with figures here, we are accountants. So there's no way you can avoid economics. You get it?
Yes, I get it. I get it.
Okay. You also, analytical procedures, these are comparisons or analysis. You're doing analysis here. You can also do a trend analysis, trends in production and sales. In your company, has production been increasing or it has been decreasing? So as an auditor, you must establish that. If production has been increasing, that is okay. But if production is decreasing, then there's a problem. You report it in your audit report that production of this company I'm auditing is decreasing. So you are alerting the owners that there's a problem. Sales, you do a trend analysis. Trend analysis will mean you look like 5 years. You see sales for the previous 5 years. You even put a graph. Have they been increasing or they are decreasing? If sales are decreasing, now there's a problem. So as an auditor, you also look at that. You also look at obsolete inventory. Has it been increasing or decreasing? If obsolete inventory is like if you're auditing Capital Shop as supermarket or any other supermarket, and you find that there is a lot of obsolete inventory, inventories is expiring before goods are sold, and it is increasing, then there's a problem. You must report it as an auditor. But how do you get to know it? You compare the expired levels of inventory per year. In 2019, how much of the goods expired before sale? In 2020, how much expired? In 2021, how many of the goods expired? If it is increasing, there's a problem. Rent, you also look at the rent. Is the rent increasing or it is decreasing? If the rent is increasing, that means it is encroaching on our profits. Since rent is an expense, there will be a problem. Also, there's also a risk that they might be inflating the rent figures. So you must compare with the tenant agreements. And if you find that the rent is increasing, if you compare with previous years and you find that it is increasing, then there's a problem. You must verify those figures by comparing the tenancy agreements, confirm that these managers are not just cheating the company. Then rates with previous years and rates and any rate increases. There are many rates here. There are like interest rates, inflation rates, and many others. Tax rates, when you compare current year and previous year, they're increasing or decreasing. If they're increasing, meaning you must alert the company of the possible effects on the profits of the company. Interest is there, interest payable. Is it increasing or decreasing? Last year, how much interest did they fail to pay? This year, how much are they failing to pay? If it is increasing, now there's a problem. This company, remember, interest is paid out of profits. So this company is not profitable. It's not paying interest. And if you don't pay interest, you are liable to fines from the bank. So there will be a problem if the interest payable is increasing. Then finance lease charges with agreements. Finance lease, most of the companies in the city here lease their assets. You go to these banks, they lease most of those cars they use. Their IFRS 16, you know it where you studied this last semester, leasing. They lease cars, they lease computers, they lease equipment. So are you paying the lease? Are you paying back the lease rentals? So you compare the lease rentals in the previous year with the current year. The lease rentals that remained accrued, are they increased increasing or they're decreasing. If they're increasing, there's a problem. And then motor vehicle running costs, if they're increasing, there's a problem. So all these you need to compare and see whether they are increasing or decreasing. If they are for revenue accounts, if they're increasing, it's okay. For expenses accounts, if they're increasing, there's a problem, and vice versa. So those are what we call analytical procedures, which is one of the key substantive tests.
Excuse me, sir.
Yes.
You talked about if maybe, for example, the revenue are increasing, and you indicated that it would ensure a possible material misstatement. Couldn't it be that maybe they are increasing because maybe probably they overvalued, or maybe they made errors in the computation of the line item of revenue that is included in the statement of profit or loss? Couldn't that be?
We shall come to that later on. It can also be one of the cases, but we shall come to it. Right now, here, we're just looking at the figures. Are they increasing or decreasing? So those are analytical procedures. The other tests you do are the tests of details of classes of transactions. This is the second set. We're looking at substantive procedures, and the first set of substantive procedures is analytical procedures. Then you're going to the tests of details of classes of transactions. Maybe one I've not talked about, you can also compare the opening balances of the current year, or for the current year, with the closing balances of the previous year. That's another analytical procedure which you do. Now, away from analytical, they're just comparisons, they're just analysis. You can just say compare or analyze. Those are the words we use. Compare or analyze. If you use other words in the exam, I just put a cross. You must, if you're analytical, you must start with the word compare or analyze. Now, after comparing these accounts, then you can test the details. When you compare, you just remain on top. You don't go into the details. So after comparing, comparisons will help show you where the problems could be. Then now you go into the details and see what caused those changes, what caused those increases or decreases. So that's why you're going to the second set of tests, which is the tests of details of classes of transactions. In topic 3, they told you about the classes of transactions. We mean items in the income statement or in the profit or loss. The first test here you do to test the details is recalculation. You do recalculations. So I can combine these ones together. Tests of details of classes of transactions, that's for the income statement, and then tests of details of account balances for the items in the balance sheet. So what are some of these tests of details? Tests of details. We test the details of classes of transactions. Those are the incomes and expenses. And we also test the details of account balances. Those are the assets, liabilities, and equity. So how do we test these details after comparison? Now, what do we expect? We expect that there could be overstatements or understatements. statements. So the first test we can run here is, this is number 2. Number 1 was the analytical, this one. So number 2 is under test of details. We start with recalculations. Now recalculations, how do you write it? You just say recalculate. Now, for example, if we go with this example, analytical showed us that payroll increased from 90 to 120. We suspect there's a problem here, but also it could be that they hired more workers. It could also be valid, but analytical just shows, it pinpoints us where the problem could be. So it's pinpointed here. There's a significant increase of around 30 million. So we want to test the details and find out what is in this 120. What is that difference? Where is it coming from? So we calculate the payroll expenses. You can calculate the payroll expenses, confirm the increments. You want to confirm the increments. So you can recalculate the payroll expenses, e.g., you can recalculate the deductions, e.g. NSSF, the statutory deductions. NSSF, have they used the correct rates? Payee, have they used the correct rates? LST, etc. Have they used the correct rates? They may have used the wrong rates. That's why the payroll expense is increasing. Yeah. So you are recalculating here to confirm this 120, this increment, this big increment. So recalculate the payroll expense, is the reductions to confirm the increments. You get it. You want to confirm the accuracy. So this will verify, we hope to verify the accuracy, the amounts. So accuracy, is this 120 accurate? You get it. But it can also help to verify completeness. You get it. Occurrence and other assertions. So you must recalculate. That's one of the other tests. Then the next one will be, the next test of details will be inspection. Okay, for inspection to external confirmation. Now this is used to verify accounts of items controlled by external parties, e.g. debtors. If there's an external party, creditors, bankers, we have our bankers, etc. So we can write to them to verify. You get it. For the payroll, who is the external party for the payroll? We want to verify this 120 whether it's correct. So which external party should we write to? In this case. So e.g. you can say, write to, or you can say confirm from, for example, the revenue authority. From the revenue authority by reviewing the pay returns, confirm correctness of the payroll. You just go to URA, you can even, here, you can write to them, they avoid the returns, but that's a long process. You just ask the client to give you his TIN and the password, you log into his system in the URA portal. You download these payees, the original ones from URA, and see how much did they actually file for 120. If you find that they filed for 20, but in the financials they have 120, then there's a problem. They have overstated, they have put ghost workers. You get it? So external confirmations, we are confirming from somebody who is outside the organization. There's an external party we are confirming from. For payroll, we are saying you can confirm the external party is URA, we can confirm from them. Because URA always will file returns for payee every month. And they have the records in their system. So we just download from there, or you can even write to them physically, you get it. But you also, there can be data. If you're auditing data, you're going to say write to the receivables or to the data in order, confirm, or you can just say obtain written confirmations from the data, confirm his or her balance in the statement of financial position. You get it. So that's how you can write that, or you can audit using the external confirmations. You can also write to the suppliers, because you'll be auditing creditors and you find that a creditor has 100 million in his account. You want to confirm whether that 100 million is correct or not. You write to that creditor. You can also write to the bankers. So you can obtain confirmations from the bank of the client to confirm whether in the cash book they might be showing that they have 80 million in the bank. But how do you verify that? You write to the bank. We shall later on see how you write a confirmation letter. Any questions on that? We started with the first test, which was analytical procedure. I showed you how to do it. We've done the tests of details. The first one has been recalculations. The second one is external confirmation. Here I told you say compare or analyze. Here you write recalculate. Here you write to or confirm from or obtain written confirmations. Any questions? Okay, we continue. The next test of details, how else do we test the details? Remember, the analytical procedures don't test the details. They only show us whether there are significant increases or decreases. But to confirm those increases or decreases, we do tests of details of either classes of transactions, those incomes and expenses, or of assets, liabilities, and equity. Then is inquiries. You can also inquire. Now, inquiries, the difference between external confirmation and inquiries is that this one is internal. You inquire from somebody who is within the organization. So we can inquire from the entity management. You can inquire from employees. You can inquire from the board. You can inquire from the entity lawyers. So for example, you're auditing IS 37. Remember IS 37? Who remembers the name of IS 37?
I think it was impairment.
It cannot be impairment.
Yeah, impairment. Provision.
Impairment is
Liabilities and contingent assets.
This is provisions and contingencies.
Hmm.
So, for example, you must have all these standards on your fingertips, by the way. If you don't have them on your fingertips, it will be blood in the exam. So you need to remember all the accounting 3 you studied. You need to remember all the questions you have studied, because you're going to audit procurement, you're going to audit sales, marketing, you're going to audit IT, you're going to audit. This auditing covers all the questions you've covered, but the major one being accounting 3. So we're going to audit management, you're going to audit BAD, you're going to audit POM, you're going to audit IT, you're going to audit procurement, you're going to audit accounting 3D standards. Everything. You're going to audit ethics. So you must be remembering all the questions you've so far studied. And even those you haven't studied, you must have an idea. So the auditor is supposed to know everything. Imagine we are auditing IS 37 and there was maybe a contingent liability. For example, there is contingent liability which you are auditing. Now, for contingent liability, e.g., NEMA has taken you to court over spilling dangerous chemicals to the environment. So me, I come to audit this. I find this in your financials. I'm coming to audit it. Now, from accounting, from IS 37, contingent liabilities, there is only a possibility of contingencies materializing. Some of them may never materialize, so there's only a possibility. You remember in IS 37, they told you if there's the probability, if it's probable, okay, you have levels, you have certainty. If you're certain, then here you recognize in the financials. You recognize that item in the financials if there is, if you're certain. Certain means 90 and above chances. +90 of something happening. That is certain. You're certain, you recognize the figure in the financials as either an asset, liability, expense, or income. You see, because there are chances you're sure that you're going to win the case. For example, if you're sure you're going to win the case, 90% plus chances you recognize it. For example, the judge has already given his verdict. Then there, even FM, somebody saying FM, oh, FM is also here. A lot of it you're going to audit it. So recognizing the financials is as an asset liability, but there must be 90 plus chances, 90%. Now, if the chances are, if there's only a probability, probable, if it's probable, for probable that is 50 to 90%. So above 50 to 90. Here what you do, you still recognize in the financials, still do the same thing. That's why in the conceptual framework of financial reporting of 2018, they tell you that you recognize assets when it is probable that they will generate future economic benefits. You get it? Probable, if it's probable. Probable. Probable means there are more than 50 chances to 90, that something will happen. The conceptual framework tells you when you reach that stage, you recognize. But if it is possible, only there's a possibility. Possible. That is above 5%, 50. Here, disclose the notes to the financial statements. Here you don't recognize a provision, but you do what? You just disclose. You don't write in the figures, you just disclose. And then finally, if the chances are remote or you are uncertain, that is below 5% chances. Here you may not even disclose, yeah? So that is it. Now we are auditing this. There's this statement which you are auditing here. This one. NEMA has taken to court, you to court. Over spilling dangerous chemicals to the environment. So how do I audit? What's my audit test? Remember, I'm using inquiries. The audit test is inquiries. So I'm going to inquire from the entity lawyers or the company lawyers. Remember, these are internal. Inquiries is for internal lawyers on the progress of the case, on the progress and stage of the case, of the court case, in order so I'm saying that we're using inquiries to audit. We're going to inquire from the entity or company lawyers on the progress and stage of the court case in order to establish whether to record it as a contingent liability, as a contingence, or a provision. That's how we do inquiries. Still, it is a test of details. You're trying to find out the details of the case and then establish whether it has been recorded correctly or not. That's from IS 37, provision and contingencies. But there are also other things you can inquire about. For example, from the board, you can inquire whether they approved certain transactions. You can inquire whether they have allowed management, for example, to recruit and other aspects. So inquiries are internal, inquire from internal personnel, whereas external confirmations, you are confirming a certain transaction or a certain asset or liability from an external party, as I put them across. Then the other test of details, we've so far looked at three, recalculations, external confirmations, inquiries. Then when you add the analyticals, they become 4. The fifth one is inspections. We start with inspection of documents. Now for inspections, they involve agreeing documents. You are agreeing documents. You know, remember the accounting cycle? We have source documents or supporting documents. Call them source documents or supporting documents. These ones feed into accounting records. Which lead to accounting records. That's in the journals and the ledgers. Then this one lead to financial statements, where we have the, the financials are not treated them at this level. So we come up with a trial balance. And then statement of profit or loss and other comprehensive income, statement of financial position, statement of changes in equity, statement of cash flows, and the notes. So, inspection of documents. Whenever you're auditing and you find that there's a document, you must inspect that document. Inspecting documents means agreeing the documents, means reviewing the documents. So you are agreeing the documents, you are reviewing them, you are examining the documents, you are checking those documents, etc. So for example, here, I can, for example, if you look at the sales, so I can take you back to year one accounting. We have source documents here for sales. What's the first source document for sales?
Invoice.
Which one?
Invoice.
Goods dispatch note.
No, it's the customer order. The customer first orders. First receive a customer order.
Okay.
Then from customer order, that order will be confirmed. You place your order and they reply to you, they either confirm it or they reject the order. After that, after it is confirmed, then it will be delivered. They will prepare the order and deliver your goods. So there's a sales order, there's a dispatch note. They will dispatch the goods. So there's a goods dispatch note, which is very key, by the way. The GD, and in accounting, that's the document that they record as goods. Remember, in accounting, we record goods when they are transferred to the customer and not when money is received. You remember IFRS 15, revenue from construction contracts? Goods are recorded when they are transferred to the customer, when there's that physical transfer. Which document transfers the goods? The goods dispatch note. So that's the document that we use to record sales. After that, other documents come in, like the delivery note. Then there is an invoice. Invoice comes at a later stage when the business is claiming its money. Though other businesses claim at the time of delivery. So these are some of the source documents. When you come to the accounting records, we have the journal, the sales journal for the credit sales. We have the cash book for the cash sales. We have the general ledger, the general ledger. Where we find the sales account. Then we have and others. Then when we go to the financials, those end up in the statement of profit or loss. That is it. Now I can develop an audit test from here. You can say agree. Remember, I'm on inspection of documents. There are many documents here. I can inspect all these documents. Agree, or I can even say match. The goods dispatch note. The sales journal, cash book, cash book, comma ledger, sales ledger, and the statement of profit or loss. To confirm, what are we confirming here from the assertions? If we do this, what are we confirming?
Completeness.
Completeness of sales, true. What else? Completeness and what?
Occurring.
And
No?
accuracy.
And accuracy, yeah? Sales. So like that. Now this one, this test is called, this is an inspection test, but it's called tracing. You're tracing. Yeah. Tracing, you move forward. You move from those documents to accounting record. This one, move forward. From source document, accounting record, and financials. So tracing, you move forward and you test, it tests for completeness and accuracy. Accuracy. Make it more practical. I can write a table here. I can even add another document here and invoices. Those two.
Bye.
If we have GDN1, we have delivered goods and it is GDN 001. Now we expect to find you post in the sales journal. We expect to find an SL1 posting in the journal and SJ1. We also expect an SL1 in the ledger. Now status, this will be a complete transaction. We have posted everything. Status, this transaction is complete. Then you go to another one. So here in the source documents, there's invoice 1, SL1 that. Now, if you find another one, you're auditing GDN 002. You find the invoice there, 002. You find SJ 002, but you find that there's nothing in the ledger. They've not posted anything. So here there's nothing. Here there's nothing, meaning this transaction is incomplete. This one will be incomplete, like that. And if you don't record in the ledger, meaning even in the income statement, there's nothing, yeah? Because we use ledgers to prepare the income statement. So this will be an issue of incompleteness. And how do we arrive at it as auditors? This is the test we use. Agree or match the GDNs and sales invoices to the sales journal or cash book, sales ledger, and the statement of profit or loss. So when you're agreeing these ones or you're matching them, that's when you find that this GDN 002 and invoice 002 were not posted in the ledger, meaning the sales are incomplete. But you can also do another test, which is called vouching. As auditors, here it is the opposite. We move backwards. From financials, accounting records, the source documents for supporting documents. So for example, I can write this test. I'm going to write this test, but in a reverse order. Example, sales transactions. The sales journal in the general ledger. Check and confirm that they all have source, they all have source documents, e.g. they all have corresponding source documents. Invoices. 2, confirm occurrence of the recorded sales transactions. Now, these transactions, they are recorded here. For example, you may find SL 004 here in the ledger. You move backwards now. You check, is there SL SG 004? If it's there, that's okay. But if you find nothing here, that means this is a fictitious transaction. It never happened. Because they recorded it in the ledger and in the journal, but when you come to the source documents, which is the starting point, there's nothing. There are no source documents. So that means the transaction never happened. They just posted in the journal and the ledger something that never happened. So meaning sales are likely to be overstated.
Where did they get that post in the sales journal?
Okay, I've not heard that.
I'm asking how can they post in the sales journal without the starting document, the source document?
Yes, that's why I'm saying that that transaction will just be fictitious. It never happened. They just want to overstate sales. They just want to overstate sales. Show good performance, yet the good performance is not there physically. You get it? Okay. So those are the two types of inspections. There's vouching, tracing, and vouching. Tracing, you move backwards. Tracing, you move forward. Vouching, you move backwards. Look at more of this. And even do it for the payroll. For example, if it's payroll, these are the synonyms I said we use. We use agree, review, examine, check, or even inspect. So for the payroll, we can, for example, employee, the employees, agree and other allowances in the contract with the master payroll to confirm completeness and accuracy of the payroll. You see this test, you're moving forward from the contract to the payroll. So it will help you in the payroll as they are stipulated in the contract. But you can still reverse this one to test for occurrence and existence. So check whether the salary and other allowances rates posted in the payroll are matching with the employee's contract from Human Resource Department. So you are testing to test for existence of employees, the occurrence of the transactions. So those are inspections. You either move forward or backwards. It's called tracing and vouching. Tracing, you're moving forward. Vouching, you're moving backwards. So that has been the first test. We started from analytical procedures. We went to recalculations. We went to external confirmation. We went to inquiries. We went to inspections. Now we're going to, and inspections, we started with inspection of documents. Now we're going to do inspection of assets as another test. Also inspect assets, confirm their completeness, and existence. So what are some of the source documents for assets? For example, we have the first document for assets is what? From IS 16. Those of you crying for your ears, there's somebody who was animated, so you kill your ears. This person called who? Yes? What?
Receipt for the asset.
Receipt.
Asset register.
Asset register. So we have source documents. Like somebody has said, there's a log purchase order, there is an invoice, there's a receipt. Then from there, we go to asset register. What else? From asset register, I'll go to the PPE schedule. But before the schedule, there are ledgers, journals, of course, and then the statement of financial position. Of course, also the trial balance. Now, in inspection of assets, we can still move backwards, test for completeness, but also test for existence. So for example, for moving forward, we can say, agree the asset register to the general ledger and the PPE schedule. This should be matching to test for completeness and accuracy of assets. Yeah. Then we can also agree we can now change this one backwards. We can say review the PPE schedule. Remember what is the PPE schedule? There are additions, there are disposals, there are evaluations, and many other things from IS 16. So review the PPE schedule and physically inspect before that, review the PPE schedule, comma, agree it to the asset register and physically inspect all the assets recorded in the register. Confirm existence of the assets. You first review the PPE schedule and see. Then those assets, are they in the register? You're moving backwards. If they're in the register, do they now exist physically? You get it. So there you'll be moving backwards and you'll be testing for existence of those assets. Assets recorded in the documents, do they exist? So those are inspections. We shall look at more of these as we go on. So we've looked at various tests. We've looked at recalculations, we've looked at external confirmation inquiries, we've looked at inspections, and I've shown you how to write all of them. I've showed you how to write all of them. That is a skill you must learn as future auditors, how to write these tests. But you need to remember all your accounting. So those are some of the tests. Now, inspection of supporting documents, inspection of physical assets, analytical procedures, recalculation, confirmations, agreeing or reconciling the finance statements with the underlying accounting records, examining material journal entries and made when preparing finance. All these we have looked at. Yeah. What are we testing? We're testing what we use substantive procedures to test for existence and occurrence, to test for completeness, as you have been hearing me saying. These ones we studied in topic 3. To test for rights and obligations, to test for accuracy, to test for classification, test for presentation. We studied in topic 3. We know what these ones mean. The assertions. Assertions of classes of transactions, assertions of account, balances. You remember that? Now, away from that, when do we perform substantive procedures? We said we use them to audit financial statements. Now, we perform them normally in the final audit. We perform them normally in the final audit. Yes. Yes. This one is just a summary. You have the details in topic 3. You get it? Yeah, it's an assertion of classes of transactions. You get it? But here we have combined them. Cutoff is for classes of transactions. It is not in account balances. Yeah. Okay. So when do we perform substantive procedures? We're saying we're using them to audit financial statements. Financial statements, we normally have them after the year has ended. So we normally perform them during the final audit. Remember, there are 2 types of audits, final audit and the interim audit. Interim audit is conducted before the year end. So before year end, normally you don't have the financials. So you may not do a lot with substantive testing. Most of the interim audits we do tests of controls with little substantive tests. So most of the substantive tests, as we have read above, are done in the final audit to detect material misstatements that may be existing. Now, I've explained this one, directional auditing. This is what I've been explaining in tracing and vouching, moving forward and backwards using those inspections. You read through this when I give you the notes. So you've seen here, I was moving forward from source documents to financials to verify completeness, then moving backwards to verify occurrence. Yeah. Now, audit of accounting estimates. Audit of accounting estimates. You remember estimates in the accounting 3, which standard is for estimates? Which standard is for accounting estimates?
IS.
That is IS 8. 8.
Okay. What does it say? Can somebody summarize it for us? IS 8.
Accounting policies, estimates, and correction of prior period errors.
Accounting policy.
Go ahead and explain. What does it require? What are the requirements in that standard?
Yeah.
Okay, simply it provides guidance on a selection. Okay, first of all, definition of an accounting policy, the selection of an accounting policy, when an entity can change an accounting policy, sometimes when it is guided for an accounting standard, or maybe voluntarily when they probably want to increase the relevancy of accounting information in the financial statements, as well as guidance on estimate and correction of prior period errors.
Okay.
And
So, yes, you go on.
IS 8 prescribes the criteria for selecting and changing accounting policies together with accounting treatment. And when you're disclosing a change in accounting policy and accounting estimate and correction of errors, for it, basically it looks at which criteria are you going to base on when you're selecting or when you're changing an accounting policy, and how you're going to treat, how are you going to treat your errors, how are you going to base on to make an accounting estimate. So that's what IS 8 is all about.
So how are changes in accounting policies treated?
Retrospectively.
Then for changes in accounting estimates?
Prospectively.
Then for errors?
Retrospectively.
Okay. So the original standard is here is 20 pages from IFRS Foundation. It has all those things those people are just from saying. So if you don't know them, we shall ask you to audit this standard, and you look Hangazi. So it is here what they have been telling you, that in the paragraph 22. So when an accounting, when a change in accounting policy is applied retrospectively, in line with this one, an entity shall account for change in accounting policy resulting from an initial application of an IFRS in accordance with the specific transactions, if that. So when an entity changes upon that, you must change it. The changes an accounting policy voluntarily, it shall apply retrospectively. This is here in paragraph 19 of the standard. This is the original text. There is no any figure here. They just rules here. So changes in accounting policy, they apply retrospectively. And they give you reasons why in the original standard here. Of course, in the accounting estimate is there, the examples are there. So, and as a result of uncertainties inherent in business activities, many items in the financial statements cannot be measured with precision, but can only be estimated. You get it? These are the reasons. I'm reading for you the original text of the standard. Estimation involves judgments based on the latest available reliable information. So sometimes we are unable to attach the actual figures on the items in the financials because of the uncertainties inherent in business activities. So, for example, what do we do now? We base the values of these assets on the latest available and reliable information. For example, bad debts. You may not know who is going to become a bad debt or not. You just estimate. You may estimate 100 million, then tomorrow they bring the 20 million. You get it. So you're not always certain on how many are going to default. You are not certain on obsolescence of inventory. Yeah. So we estimate that this inventory is likely to become obsolete. It's like obsolescence is caused by many factors. One of them is expiration of the product. That one can be predicted, but changes in trends. Like if you're dealing in fashion items, trends keep changing. They may not be predicted. So you can estimate. The fair value of financial assets and financial liabilities. Financial assets like investment in shares, investment in bonds, or financial liabilities like when you get a loan or when you issue a bond. So the values of these items also keep changing. We may not know their actual figures with certainty. What do? We estimate. But when we estimate, we normally use a lot of judgment. We use our intuition, we use our own knowledge and experience, which may not be so accurate. But also we may use this chance to overstate our financials. If I want to show that the company is doing well, I will play around with these estimates, yeah? Though it's unethical, but people do it, yeah? So they end up having the wrong figures. So that's why we are auditing these estimates, that to estimate the figures, not using a standard measure because of uncertainties leads to confirm whether those figures. Also, we estimate the useful lives of different assets, since we may not be sure when up to when we're going to use that asset. And then warranty obligations. So the use of reasonable estimate is an essential part of the preparation of financials and does not undermine their reliability. So there's many requirements here we should do. And as they told us that we recognize it prospectively. So the effect of a change in accounting estimate, other than a change which paragraph 37 applies, shall be recognized prospectively, including it in the profit or loss in the period of change, if the change affects that period only, or the period of the change and the future periods, if the change affects both. So this is paragraph 36. When we are auditing, we read the original text of the standards and we quote these sections of or paragraphs of the original text. When you're writing your audit findings, practically for the client, you'll be like lawyers, you quote the section of the law. So these are our laws. We quote that you violated section 36. Instead of recognizing the accounting estimate prospectively, for you, recognize it the other way around. So I quote for you section 36 of the standard, and we face it off. You get it? So I'm training you practically. This is what we do practically in auditing. You get the original standard when you're writing your findings practically, and support your findings with the actual sections. You tell section 36 requires this, section 33 requires this. So you've noted the errors are also there. We said these ones are also corrected. Period errors. Subject to paragraph 43, and enter shall respective finding as an. So we need to read this. This is one of the smallest texts, and for us to read the original text as audit. So how do we audit them? We have said the problem with estimates is one, there's no physical evidence to support them. Somebody has just estimated, so there's no any physical evidence. You may not even find any document they are basing on to estimate a figure for For example, it's apply for an asset. For example, a provision for court case. For example, obsolescence. Somebody just think out and says 10% may default, but is not basing it on anything, yeah? So no physical evidence. So that one makes them susceptible to misstatements. Also, their measurement is highly subjective. Subjective means we base on our own knowledge, our own experience. So if your own knowledge and experience is not good, you're going to end up estimating the wrong figures. Then they may easily be used to manipulate financial statements. Those are the risks. That's why you are auditing them. Somebody may want to show a profit, and what does he do? He just goes to the estimates and either increases them if they are for incomes, or reduces them if they are for expenses, and understates them. So what do we do when you're auditing them? ISA 540 requires us to audit accounting estimates and the related disclosures. Because whenever somebody estimates something, he puts a disclosure in the notes, like his basis. So we want to audit and confirm that the figure he has put and the reason are substantial, are correct. So what do we do? The first test we do, remember we have audit tests. You remember them, analytical procedures. We have inquiries, we have inspections, we have external confirmations, we have it, and others. So one of them is inquire. We can inquire from management. Where did they base to say that 10% are going to default? Where did they base to say that they are going to win the case? Where did they base to say assets are going to have 50 years? So they're going to be depreciated at a given rate. You get it? What was the basis? We can inquire from management how they made that estimate. How did they arrive at it? Are the assumptions they made right or not? Because they make certain what? Assumptions. So they will tell you, we based on a similar asset which we had last year, or we based with the asset we had, we used it for 5 years. So we think even this new one, we shall use it for 5 years. Or they say we had the same court case last year and we won it. So there's a precedent. They're basing on that to record a provision or to disclose a contingent asset. You get it? So you're going to verify those what? Assumptions as an auditor. What do? The test is you inquire from management. Now, when you're writing these audit tests, you must be very precise and concise. We don't rotate, you don't beat around the bush. You don't start I, we. You're not saying any I, we here. Just say inquire. You get it? So this is an inquiry. You can either use E or I. Then review, whenever you see review, that's an inspection. So there are documents you're going to inspect here. Review the judgments and decisions of management in making the accounting estimate. So this management sits in a meeting and they have minutes. So you can review those minutes of the meeting, the resolutions they came up with in the meeting. So you review those documents and confirm that they followed them, because they may discuss in the meeting and they come and do something else. Or they may discuss something wrong, which is not in line with the standard. So you must review their judgments and decisions which were put on paper in the meetings and confirm that they were not biased in any way while estimating these figures. But also, you do what's called a reasonableness test. Reasonableness test is all about, we said, looked at it, comparing what you expect and the actual. What did you expect? For example, you've looked at the Income Tax Act. In the Income Tax Act, we have the classes. In the business income section 20, you have the business what? That is scheduled in section 20 business income, but the rates, the classes are in a certain schedule. In schedule 5, what schedule is that? Where we find the classes for assets, wear and tear, around schedule 5. So you find that, first, what is the percentage in class 1 for wear and tear?
40%.
So which assets are in class 1?
Storage devices and computer.
Like now in class 1, they are computers, for example. So you expect that their depreciation will be 40%. 40%, what's the useful life? When you find 40%, what will be the useful life? Remember, depreciation percentage is gotten like this. They taught you in accounting. It equals to 1 over useful life times 100%. So if the percentage is 40, how many years are they? How many years has URA given the asset? You work backwards here using this formula.
4 years over.
They can't be full. You make it the subject of the formula and get the number of years. 40%. How many years? They're around 2.5 years, isn't it? I'm getting 2.5. Anybody else getting 2.5 years? You have 40% here, equaling to 1 over useful life times 100. So you work out the math. So 40% same as 2.5 years. So URA expects you to use the computer for only 2.5 years. But if as an auditor, I find that you have estimated, remember you're in estimated 7 years for the computer, then there is a problem. Then this is a risk of material misstatement. You get it? You are trying to understate depreciation. You're understating it. Because 7 years, that what will be that percentage? 1 over 7. So for you are giving it 14%, 14.3%. You're depreciating the computer at 14.3%. Me, I come knowing the URA rate. Then I find you have given it 7 years, which is 4.3%. Remember, depreciation is an expense. So you are understating the expense, overstate the profits. You get it? So there will be a risk of material misstatement. Profits are overstated when the managers want to appease the owners. They want to show them that they're doing well. When they want to list their shares on the stock exchange market, so that they're doing well, they use such antics. Yeah. When they want to borrow, they will adjust these rates so that they can overstate the profits. You get it? So that will be a reasonableness test. I'm testing what you did and what I expect. I expect a computer to be depreciated at 40%, but for you are depreciating it at 14.3. So in my reasonableness test will show me that there's a problem with that estimate. You have estimated a lower depreciation rate so that maybe to overstate profits, either you want to list your shares or you want to borrow or you want to show management that you are doing well. Also, we test, yes?
And there are circumstances where you can adjust the useful life if the computer is still in good condition.
Yes, IS16 allows. It allows IS16 requires you to review the useful lives of the assets periodically. And if you find that the asset can still work, you can you give it more years. IS16 allows. Okay. Test whether controls over development of management estimates are operating effectively. So are there controls to controls like before you make an estimate, the board must approve it. Board must approve estimates like bad debts write-offs, how much bad debts write-off, what depreciation rates. The board must approve it. Those are controls. So did the board approve Are those controls being followed while they are making the estimates, or they're not being followed? You get it? So you test that. Controls like an estimate like depreciation rates, the board must approve it, so that if you have overestimated, they correct you. If you have underestimated, they also correct you. Or sometimes they may ask you to, the policies of the company, the controls may require you to involve an expert. Did you involve the expert or not? Then as an auditor, also obtain written representations from management. Written representation means that management writes a letter. It's also called a letter of representation. Management will write you a letter confirming that they are the ones who made those estimates and they believe they are true. So you obtain the written representations. They can also be in the form of management meeting minutes or resolutions taken. Those will be evidence. That will be evidence that management is down that past, that so that in the future they don't deny that they're not the ones who did those estimates. So you obtain those written representations in the form of board resolutions, in the form of management meeting resolutions, in the form of minutes for those meetings, to have evidence that management accepts that they are the ones who made the estimates. And then check proper disclosure of the estimate in the financial statements. You must check whether the proper disclosure has been put. They must explain how they arrived at those figures in the notes. So that's how you audit accounting estimates. We already looked at the meaning of analytical procedures and explained them. But when do we do analytical procedures? When do we do those comparisons? We can compare the planning stage. When you're planning for an audit, you want to see where risks are. So for example, you can run a small test. You compare revenues for the last 5 years. You want to get a picture of the entity. Is the revenue increasing or decreasing? You can use them in the real audit. That's the performance stage. And then the reporting stage. The reporting stage, when you have completed the audit, you want to do final comparisons of those figures like budgets and actuals and others. Come up with a clear picture of your findings. There are steps you follow before you use analytical procedures. Are they suitable? You must ask yourself, are they suitable? Will comparison give you the right evidence or not? Do you have reliable data to compare? If you don't have reliable data to compare, then you don't use them. Then develop an expectation of recorded amounts or ratios. You can use ratios, by the way, also use ratios to compare. Like gross profit margin for the current year or the previous year, so you compute the ratios. And then also, after comparing, you need to investigate what is causing those changes. So these are like factors you must consider before you use analytical procedures. Suitability, reliability of data. You don't compare data which is not reliable, but also you compute ratios which you are going to use to compare. Or you also come out with the expected amount. So you must have two amounts to compare. There is a question here for analytical procedures. I think you did it in topic 3. You did a similar question like this, where you use the ratios. Now, audit of non-current assets. So the next time we meet, you're going to start from here, audit of non-current assets.
Thank you so much for watching. Make sure you subscribe to the channel.